Good evening, everyone, and thank you so much for joining this session tonight. Let me just take a moment to introduce myself, and I apologize that we're starting a bit late. Obama is in town at the Waldorf, and so the traffic getting up here was just very bad, but thank you so much for being here today. I'm Joyce Chang. I run the Emerging Market Strategy and Research and Global Credit Groups at JPMorgan. Columbia is my alma mater. I came here back the first year that it went co-ed, actually, in the college. And I work at JPMorgan, but have a public policy degree from the Woodrow Wilson School at Princeton, and for many years have really spent time looking at both the emerging market strategy side and how we help sovereigns and corporates raise money in the international capital markets, but also the work that that many people in my group in emerging markets have done with many of the organizations that are here. I'm myself on the board of Trickle Up, which helps segments of the population that live in extreme poverty. And we have a fantastic session for you today. But I thought I would just start with a few comments on where emerging markets is today. So as I was coming up in the cab and just looking at the headlines, I think if you didn't see the news, the United Kingdom was actually downgraded just a few hours ago, joining the U.S. in losing its AAA rating from one of the credit rating agencies. And I think the amazing thing for me over the last few years is to watch the macro transformation that emerging markets has gone through. I'm an emerging market specialist by training, but in 2008 I took over running the U.S. and the European strategy groups and credit groups in the middle of the global financial crisis. And JPMorgan basically said, look, you have the most experience of anyone working with bailouts. So the U.S. and Europe I've worked on, and it has been a very dramatic transformation to see what has happened to emerging markets. If you look at our forecast for GDP growth this year in emerging markets this year will account for about 80% of the contribution to global growth. China and Brazil alone, 50% of the contribution to global growth. It's not a great year for global growth, but emerging markets will grow at 4 times the pace of what we're forecasting for the developed economies. If you take a look at the world's global foreign exchange reserves today, of the $10 trillion in foreign exchange reserves, 80% of them are held by emerging markets countries. And if you look at the way the world has re-rated, the U.S. high-grade corporate bond index, the most liquid index market in the world, except for U.S. Treasuries, now has exactly the same credit rating as the average emerging markets countries, because it was downgraded so much during the global financial crisis. So we really are at a turning point for emerging markets from a macro perspective. Emerging markets have probably never had it in such a way where the world has turned in their favor. And if you take a look at just the debt burden and the debt overhang, emerging markets countries now have an average public sector debt to GDP ratio that's around 38% of GDP. The average developed country increased their debt ratio by an average of about 30% of GDP during the global financial crisis, and has a debt ratio that's about 103% of GDP on average. And even just looking at a Rogoff-Reinhardt analysis of how long it takes to work through a debt overhang like this, for most sovereign debt crises, it's taken an average of 23 years to get out of that debt overhang. So we're looking at a world that has re-rated. And the latest report from the World Bank actually brings some very welcome news on the global poverty front. Despite the global financial crisis, the total number of people living in extreme poverty has actually gone down in the last couple of years, so much that it's reached the first of the United Nations 8 Millennium Development Goals 5 years ahead of schedule. And the number of people living in extreme poverty actually decreased by 100 million between 2005 and 2008. So a lot of progress has been made at the macro level, and actually some strong gains at the extreme micro level. What about the missing middle? That's what we're here to talk about today. How accessible are financial services and capital to small enterprises in the developing world? What progress has been made investing and improving the livelihood of entrepreneurs in those communities? And what are the biggest challenges right now for and the opportunities for scaling early stage impact investing? So how does JPMorgan define this asset class, and are institutional investors interested in this? Well, we have seen a real increase in getting into the newer emerging markets, and last year we actually launched an index called Next Generation the next generation markets, which are 25 frontier markets. And if you actually look at the year-to-date returns, because it's not correlated, that's actually been the highest performing asset class year-to-date in 2012. I mean, you basically are looking at returns in U.S. equities and in many markets that are back to zero after having a very strong performance in the first couple of months of the year. And we classify 25 countries, many of them which we'll hear about, as next generation markets. But next generation markets, more than half of these countries are in the bottom half of the World Bank's ease of doing business, the average rating for transparency on a scale of 1 to 10, with 10 being the most highly, very clean, and 0 being the most corrupt is only 2.9. So a lot of challenges. At JPMorgan, we actually created a social finance unit, and initially the opportunity was fast-growing microfinance sectors where dedicated private investment vehicles were proliferating, and JPMorgan started investing in some moderately sized microfinance equity funds. The last few years has actually focused on establishing impact investments as a recognized asset class among investors, trying to harness interest in the capital markets. But there's a lot of challenges that remain, and maybe I would just list a few that I see. First, there is just sourcing viable opportunities at a sufficient scale to justify the structuring, the due diligence, and the distribution costs. We've actually seen a lot more interest in actual opportunities that you can bring to market on scale. It's largely a private placement market. The deals are highly bespoke and tailored to specific social or environmental issues. There's also that the track record of the business and fund managers is often limited, but you have some of the best in the business here tonight. And the third-party systems for how you measure social impact are just beginning to emerge. So there's a lot to talk about today, and I'm delighted to introduce such a distinguished group of panelists today who are just truly passionate about what they do, who live and breathe this stuff, and who are really breaking the ground for what's happening next. Because the era I started in post-debt crisis was the era of grants and basically, foreign aid assistance. And it's great for me to see just what has happened more recently. The panelists tonight have worked across both the private sector and nonprofit world, setting new directions for social entrepreneurs to create venues for investing in the missing middle in all regions and emerging markets. So let me briefly introduce them. We have until about 7:30, so I have some questions, but want to keep this as informal as possible. So sitting next to me, Ben Powell, 2005. Who is the founder and the CEO of Agora Partnerships. And he became convinced of the power of small businesses to transform poor communities in Mexico, and has also worked extensively in Central America. He co-founded City Golf Puebla, a miniature golf course and family recreation center. He was a presidential management fellow, a very prestigious internship at the Office of Management and Budget. Then he came back to business school. He launched Agora Partnerships, and since graduating, he has been on the who's list for social entrepreneurs. He's been named the Draper Richards Kaplan Foundation Entrepreneur, BMW Foundation Young Leader, and an Ashoka Fellow, and also one of the top 40 under 40 development leaders to watch. A real pleasure to introduce William Haughey, who is the founder and CEO of Tegu, which makes toy blocks using environmentally sustainable manufacturing materials and has its practice in Honduras. And Will oversees all of the commercial activities, including the global marketing, the sales and distribution platforms, and the product development process. Like many of the panelists here, he has roots in the private sector as well, and he worked in healthcare investment banking at Goldman Sachs, and also for Goldman Sachs Investment Partners, where he managed public and private investments before he actually founded Tegu in 2008. A real pleasure to introduce Gustavo Eiben, who is principal and head of investor relations at Aureos Capital. And he has been with Aureos since 2009. He's worked on investor relations and also the new product and business development that fits their overall strategy, including fund establishments, new fund operations globally. And before that, he had more than 10 years of experience in private equity. He was also at JPMorgan with the private bank and in charge of fundraising and business development at Schroeder Ventures, and also with UBS in the private equity fund. So a lot of private sector experience to the table. And Amie Patel at the end of the table, investment officer at the Soros Economic Development Fund and responsible for the Haughey portfolio. And before joining Soros in 2008, she was the investment officer for the Overseas Private Investment Corporation, where she developed and evaluated emerging markets private equity funds. She's also worked as an M&A analyst at Merrill Lynch and also at First Union Securities. And she was a program manager for student partnerships worldwide in Nepal, working on environmental education and women's issues. So I think that this is a group that can probably span any question that you have. But I'd like to just start with having each of the panelists just share with us what are some of the examples of innovation by investors and entrepreneurs that address some of the EM challenges that have been laid out. What are some of the key lessons they've learned as they've set up their own businesses and models? Which models have worked the best? And what did they underestimate when they first started working? And how are they looking at the most effective way to address poverty alleviation in emerging markets? Why don't I start with Ben?
Great, thank you. Thank you, Joyce. It's great to be here. So maybe I'll just begin by saying that we all come from a different perspective, and my perspective is that of somebody running a nonprofit, and our mission is basically to create social impact at the most cost-effective way possible. So we try to create business models that result in social and environmental change in the most efficient way possible. And what we did when we were at Columbia, and it's great to be back here because we had about 25 students at Columbia Business School who were working with us to get Agora off the ground. And what we did was launch a small fund to try to figure out how to invest in very small, early-stage companies in Nicaragua, debt and equity. And that fund is now fully invested. We've made 11 investments. About 5 of them, the companies no longer exist. 3 of them, the companies are doing okay. 1 of them, we've had a very successful exit that resulted in a mini cottage industry in Nicaragua, and the last investment has actually received a lot of more traditional venture capital and is hopefully going to create an entire industry of bamboo in Nicaragua, building low-income houses out of bamboo. And I guess the number one sort of lesson that I think I've learned in this business for the last 7 years now is that it's really, really difficult for early-stage impact investors to try to do it all on their own. And we're really at the very beginning of this industry. And you have a lot of new investors kind of setting up shop. But the metaphor that I like to use is that it's sort of like we're opening up our offices on Sand Hill Road, but there's no Stanford University that's providing pipeline of vetted investment-ready entrepreneurs. And so what we have decided, after looking at how we can kind of make the biggest difference, is that what needs to happen is there needs to be a sort of an ecosystem that is much more developed and much stronger around early stage venture creation. And so for that to happen, there needs to be a market where investors can identify at relatively low cost high growth companies that want investment and that understand what investors need and want. And if you don't have that, then as an investor, you're really being asked to do an enormous amount of work on your own. And the risks are so high and everything is so new that it makes it very difficult to kind of operate kind of on your own. And so I think that the future of this whole industry is going to be really building a much better marketplace at the early stage so that investors are able to identify talent and entrepreneurs are able to better learn and understand what investors need so that they can eventually get investment. And maybe I'll just give one quick example just of how a small business can actually make a huge impact. And this was our second investment. It was in a guy who was running a small foot clinic. We lent him $40,000. That foot clinic then started to expand. He prepaid us, so within 5 months we had our money back, so we didn't make a very big return. But what then happened was that very same foot clinic, not only did it expand, but new foot clinics started to enter the market because he created a market of very low-cost foot clinics. And so now there are dozens of foot clinics in Managua, Nicaragua, where this business was launched, and that has generated an enormous amount of economic activity, enormous amount of jobs, and a very important service, which is foot care. And so it's just one example of how a loan for not that much money can result in a very successful kind of chain of events that results in economic productivity and products and services that people actually need. And that to me is sort of the essence of economic development and the real promise of this whole industry that we're involved in of impact investing.
Thank you so much, Ben. Well, let me turn to you. And you've participated in the Agoura Accelerator. Can you tell us a little bit about that program, what you got out of it? What is the role for accelerators in building early-stage impact investing in the marketplace? And then this whole issue of building a much better early-stage market, what were the key lessons that you learned?
Sure. Well, it's a pleasure to be here tonight. I just want to quickly describe our business model, which I think will help kind of put in context the way that we interface with Agoura. So Tegu is it's a toy company. My brother and I are the founders. We didn't set out to create a toy company. My brother had been traveling through Honduras, and he was struck with the degree of poverty and said, okay, how do we deal with this? What exactly could we do commercially or within the market to actually harness opportunities within the market to create social good? And ultimately, he gravitated and we gravitated to the native natural resources of Honduras, which we found to be in their forests. They have plenty of others, but it's a great natural resource there. And our view and early thesis was this is an underutilized resource. We then started thinking about the application of that particular asset, and ultimately, through various international travels, ended up in the toy industry of all places. So I have no toy industry experience. I wasn't even a Lego kid. But we started a toy company, and our goal is to build the world's most innovative premium toy company. Slightly different than some of the other accelerator companies, Tegu has offices here in the States as well as in Honduras. We have a factory in Honduras which produces our product. And we've got now about, we're just about to go over 100 employees at the factory there in 2 shifts. We do use local hardwoods. We do transform them, and we export all of our product to the States for the most part with a little bit of international distribution. The key for us also is that we have a U.S. presence. Our sales and marketing and product development offices are based in Darien, Connecticut, about an hour from here. We sit very close to the end consumer, so our product development happens in Silicon Valley kindergartens and elite schools around the country to really understand what makes toys great. I say all of that to say that most of the companies that are part of the accelerator program that Agoura established don't necessarily have that linkage or that established sort of beachhead in the export market, and some of them also are focused on the domestic markets as well. Great innovations for the base of the pyramid, and Ben mentioned Bamboo Company, but there are many others that they experience. And I think, to go back to your question, my experience in the accelerator is that it serves as an advocate for companies like ours. We were essentially non-existent 3 years ago. We needed to raise money. We needed to articulate our vision and make it clear as to what we were actually trying to do. And then we needed people out there basically pleading with others in sort of the investment community to sort of say, okay, this is worth taking a look at. Maybe you should consider ways in which this could actually satisfy your interest in the impact space. We'll talk probably more about this later. Our primary social objective is job creation. We do care very carefully about our supply chain and reforestation and things of that nature. But when we speak to investors and impact investors and when we interface with Agoura, part of the missing middle is just that there aren't jobs and job opportunities for graduates. So even if you fix the educational programs and you create opportunities for the poor, if you don't have businesses that can employ those individuals, then you have a really difficult time sort of rising people up through the poverty that they face. So suffice it to say that our experience, we were part of the inaugural accelerator class for Agoura, and we were brought together with, I think, 11 other, was it 11 or was it 9? 9. 9 other portfolio companies, all throughout Central America, all focused on growth, and all very interested in articulating a social impact. And I would say that's the innovation that we've seen, which is somebody like Ben and Ben's organization came out and said, okay, we know the work that's going on in the field. We know people are passionate about creating change. We know they also want to create returns. So why don't we just sort of convene this group of people in the field and then present them once they're ready to the rest of the world? And that's exactly what we've experienced in our time with Agora.
Thank you so much, Will. Gustavo, let me turn to you. Can you share with us how you've brought all of your background in private equity to bear in developing the new businesses and products, and what are some of the key lessons that you've learned? What did you underestimate when you first started working and making this transition from private equity over to Aureos?
It's a tough one. That's a tough question, but I will be a little bit provocative here because I think sometimes what we need to understand is basically how we are presenting this concept, this opportunity, this story to the people that we provide the capital for us to do it, because I think that's a little bit what we're missing here. Aureos is a typical private equity firm. Commercial 100%. We are global in the sense that we invest in Latin, we invest in Asia, we invest in Africa, and most recently in MENA. So a typical private equity company, all for profit and so on. In 2010, we did a special social fund called the Africa Health Fund. And that fund was a little bit different because it was targeting different type of returns. So when we started that fund, we first of all defined we want to keep doing a very clear ESG type of investment, which is what we have done in our hardcore private equity funds. But we want to be sure that this fund is basically sustainable. And basically, sustainable sometimes is different from, impact for being socially responsible and so on. By sustainable, we wanted to be sure that we were investing in companies that will be able to survive. And the other big questions that we were facing is we have this great idea of trying to help the BOP in Africa, people that basically were living with $5 to $10 a month, don't have access to healthcare and so on. We really wanted to help that, but who's putting this money? I mean, how are we raising these funds? I mean, everyone here, I'm sure, wants to do something great, something good for the community. Now, in my world, because I face it every day, I got to turn and sell these ideas to people. Yeah, because $100 million fund, I can't put it on my own pocket. So, with that in mind, sometimes I feel that when we keep talking about the missing middle, we are not defining this product the way we need to define it in terms of being a sustainable product going forward. And basically what I mean by this is, again, I need to be able to sit with an investor and say, this is a product that will be invested this way, have very high risk profile, because as Ben says, sometimes you invest in 11 companies, out of the blue you lose 3 or 4 right away. This will be your return, very clear, and more often these investors will want something higher rather than lower for the high risk that they are taking. And this is a type of sustainable impact, ESG, responsible work that we are doing in these communities. But if we don't tie everything together, I keep hearing these stories about constantly effort about trying to raise this type of capital, trying to put to work these type of things. And it's tough. It's very complicated because there's kind of a frame that is missing, in my view. Now, that's in terms of attracting capital from more institutional LPs. Now, when I have the capital, I think to Joyce's question, what were the challenges that we were facing? Is that we went to the market in terms of deal sourcing, management, exiting ideas, the way we used to go to our typical private equity funds, because we wanted to make those kind of returns. And guess what? It didn't work. So for a good year, I would say, we couldn't source one company in that Africa Healthcare Fund. And the reason was very simple. When we were talking with the Nairobi Women's Hospital to get our equity in that company, it was just an absolutely, and I've been there, absolutely nonsense conversation. Absolutely nonsense. I mean, I was talking about private equity. They keep asking me 10 times how much interest they had to pay me. So there was absolutely no private equity concept, understanding anything. Mm-hmm. So, at the end of the day, there's no communication, period. And that's a challenge. Is not just sourcing the right deal, but then make them understand what private equity is. Apart from all that, trying to just think about how I'm going to get a 15-20% return in Nairobi Women's Hospital type of thing. But my investors, that was a mandate. Yeah, that's a mandate at the end of the day. So it's not easy. I guess that's a summary.
So let me turn to Amie. Haiti. How do you support the creation of markets where they just don't exist? And when you look at the regions that we've talked about, and a place like Haiti, which is in such turmoil right now, how do you actually create something given the level of market inefficiencies and turmoil that's going on in the country?
I'm not sure that we single-handedly create anything except for specks of opportunities for private capital to be placed. So in a country like Haiti, where, as you all probably know from the news, there's a lot of donor capital that flows in, and so you're constantly competing against free money and the concept of handouts. And so your job as an investor is not only to find little gems amongst all of that, but to educate the other side to not only think about private equity, but even just loans or something that has to pay back over some sort of period. So there's a lot of education that's required. Haiti is a slight anomaly in the sense that there is a business community that exists, and they do understand loans and equity and some sort of corporate structure. But that isn't necessarily where an investor like SEDF wants to engage. We want to engage with new entrepreneurs and give those that do not have access to opportunity. And that's essentially the missing middle that we're discussing. It's not the microfinance borrower, and it's not the corporate borrower that's been a monopoly business for decades that you want to target, but you want to talk about new graduates or diaspora community members that want to go back and establish a new business in the country, or just even those that have been in the country and want to start something new on their own. And finding those kinds of opportunities is tough, but we had a little bit of help with the special envoy out of the UN that was head up by President Clinton and the Inter-American Development Bank and their engagement in the country to spur up business and private investment energy. And we worked with the Chamber of Commerces across the country to sort of spread the word that there are potentially investors available to place capital. But then you have the flood of people presenting their one-page, two-page business concepts. And as an investor, that's not really going to make you comfortable into placing capital. And then you start the whole game of, okay, well, what's your business plan and where's your financial statements and what am I assessing to then think about placing capital with? And then how are we going to place that capital and what does that capital look like? And that has been the most challenging part of investing in a country like Haiti, because developing that pipeline, as Ben had mentioned in the very beginning, is the hardest part of these frontier markets. There's a lot of people with a lot of big ideas, but they have no idea how to execute. And so you end up hand-holding a lot of that process, and that then eats into your overall time and commitment, and you can't move on to the next project. And so you essentially, in one way or another, dig into your returns. And so it's a hard equation, and the variables in a country like Haiti and a lot of the frontier countries are constantly moving. We, fortunately, as an institution, do not have to put a ticket on political and country risk. It's something that is just built into our thesis because of our donor. We don't have to answer to investors. So we have a finite amount of capital. We have a board that we have to answer to, but political risk and country risk isn't priced in. So you can start to make somewhat of a single-digit return from some of these investments. But again, it's not easy.
Thank you very much, Amie. And it's fascinating to hear all of this. I had started my career before I worked on Wall Street at the U.S. Agency for International Development, and that was right at the point where they were beginning to just start talking about privatization and microfinance. 25 years ago, and so to see how that this has evolved and sort of how the younger generation of students coming out of business school are looking at this is fascinating. But I'd like to ask a question about leverage. So I work on transactions that are bigger than the ones that we're talking about, but the whole issue of leverage is very hard, even when you're working with issuers that have gone through a lot of due diligence. So there was a period a couple of years ago when a lot of emerging markets corporates borrowed and they defaulted. And a lot of this happened in many of the former CIS countries. And I remember talking to one investor, and he said, look, I own 80% of this bond issue, and I'm not even allowed in on the creditor committee. And I asked him, well, what's your strategy? You own 80% of the company, and they're not even allowing you into the committee. And he said, well, I'm going to wait 3 months and call back and see if somebody else answers the phone. So I'd like to ask you on the whole question of leverage, what is your leverage? Because the leverage I found, even with big transactions, when something goes wrong in a high-yield transaction, I mean, it could be a China property company. It could be a cattle company in Brazil. It could be a financial institution in the former CIS. I feel like many investors coming into these newer markets really struggle with the whole question of leverage. So when something goes wrong, how do you execute leverage? And Amie, I'd like to pick up on the point you made that sometimes you can achieve single-digit returns. We found that the investors who are interested in the social ventures don't expect the same kinds of returns. And oftentimes it's part of their bylaws that they have to make these types of investments. But what is the range of returns that you're seeing, and how are you seeing that evolve? I mean, as far as the types of projects you're working on. So how do you have leverage when something's going wrong? And what is the return that you're targeting, or how do you see the market evolving?
Well, for the companies that we work with, very few of them have a lot of debt on their books because they can't even access local debt. So it's usually the entrepreneur who's put everything on the line. And in fact, I think leverage actually is, in debates about kind of social impact, there's a whole debate about scale versus leverage, and I actually think leverage is the most important word probably in our industry because, and the way that I would define leverage is, at least for us, right now $1 of philanthropic capital invested in our accelerator results in about $10 of private capital flowing into very small businesses. And we're trying to move that number up. But that to me is like when I think of leverage, because the other companies that we work with just typically, they're not that leveraged.
Yeah.
I'll answer briefly. I just was running some quick math. So we're in the midst of our second fundraise right now. The paper profit's a 21% compound return. We have no debt. It's all been private funding and private equity from individuals and one family office. In terms of leverage specifically, I think exerting leverage as a question is very difficult, primarily because what we've seen, at least in Honduras, is, and I mean, you sort of mentioned it earlier, but you do have an established wealth class and you have an established elite, and they have tied up the industries and economies of interest. They've sort of picked up the low-hanging fruit. And then you have everybody else. And there is not a picture painted for everybody else to sort of say, okay, yeah, I could do that. I could actually go out there and start something and make something of it. And what we've seen, when we've seen in Honduras, for instance, and we're always just looking at things on the ground as we're sort of doing our work, is there's some really great business models, and some really great business models that also serve the poor, and also some people who are in the elite who want to serve the poor. But when you start talking to them about saying to them, okay, you got a great business model, you got a great opportunity for impact, they have zero interest in giving up ownership. So the likelihood of a foreign private equity firm owning a controlling stake, for instance, in an emerging market company, given the sort of cultural biases towards essentially full ownership or 100% ownership, means that essentially you don't have a class of folks interested in starting businesses and also ceding economic control. So when you think about investing in a frontier market and specifically making a direct investment into a company, the likelihood of owning a controlling stake is very low. You might be able to have a board seat or two, but ultimately when it comes down to it, if you can't get control, you're investing in people. And you're investing in entrepreneurs. So I would say that leverage would be very hard to exert. The rule of law often is very hard to enforce, and corruption is rampant. So I would say this is one of the biggest challenges facing the flows of capital, responsible capital, from the developed to the developing world, which is basically people don't want to cede control.
Yeah, Gustavo. How do you enforce? How do you if something's going wrong on one of these projects? How do you enforce making the rule of law? Come into effect?
I would say the best way we deal with that type of risk is by having 150 people on the ground. I mean that's how Aureos works. And I will, it's kind of funny, but it's not. I always say that the riskier market for us will be the US or Europe, because we have no idea how to do business here. So every single market in which we invest, we have an office there, and we have probably anywhere between 4 to 10 people, depending on the office. Now, we do, agreeing with Will, we are very unlikely to do majority. So most time we do minority, but we do significant minority, and that allows us basically a couple of things. First of all, to put our CFO, which at the end of the day is the guy that manages the money. So that's very important for us. The board, it's good, but we always have 1 or 2 seats in the board, which helps, but it's not critical either. I think what we do that is a little bit different from any other private equity shop working in emerging markets is that we tend to enforce something that we call cash preferential rights. And basically what that means is that if you take the life of a fund, which is 10 years, and basically the investment period is usually 5 years. 5 years in emerging markets is a lot of time. Anything can happen in each of these countries in 5 years. So basically what we tell the management team when we're investing is that we're going to have cash preferential right. So by the end of the year 5, we are not in dark with where is my money. So by year 5, at least I have recouped anywhere between 25 and 50% of my investment, deleveraging some risk out of the equation. the other flip of the coin there too is that if you're investing in emerging market, it's because these companies are growing fast, and you don't want to take the cash out of the company if these companies need the cash to keep growing. So there's always a fine line there, and then you always have all the structuring, the drags, and so on. But I would say, and I would finish with a very clear example about what's your leverage there. Not that long ago, I got a call from a very good friend of mine working for a fund of fund here in Park Avenue. So he basically called me and said, you got to help me with a company that we have in Thailand. I said, well, what in the heck are you doing in Thailand? I mean, you are a pure U.S. Fund of fund investing in tech. So absolutely no sense for these guys to have an investment in Thailand. So I said, let me guess what's happening. You probably invested 20% in this company. You have no idea what's going on. You're putting a call to these people. These people are not even picking up the phone. And he's like, that's exactly right. And he said, and for all those reasons, I'm going to try to sell my company to you at one-time EBITDA. I said, listen, you're my friend. I don't want to screw you up. But let me put a call to my colleague in Bangkok to see what's how we can help there. So I put a call to my colleague in Bangkok, and within 5 minutes he called me back and said, well, this is the situation. You don't touch a family, period. And I don't care if that company is coming for free. You just don't do business with that family. But if you're here in Park Avenue, you don't know that. Yeah. So I would say that's our leverage.
And I think that is one thing that I've seen with some of the emerging markets transactions we worked on. There still are, I think both Will and Gustavo have pointed out that you still have a lot of the businesses that are really controlled as oligopolies by the elite. And even if you do all of the due diligence and cross all the T's and dot the I's, when something goes wrong, that your leverage as a foreign investor can be very, very limited. The ability to get somebody on the other end to pick up the phone and make this a two-way playing field is also very limited. But Amie, in Haiti, just given such a difficult backdrop, and as you mentioned, just a mentality that's used to donor assistance rather than necessarily making something more commercial, how do you enforce and make sure that you have leverage over the implementations of the projects?
It's funny you asked that question, because we've had a lesson, a very big lesson just recently in the country of how we should have thought about leverage from the very beginning. And having 20/20 hindsight, I can say if you don't align incentives from the very first day in structuring the deal, it doesn't matter who you are or how much money you bring to the table, you're going to lose. So, echoing what Gustavo was saying, by having talent on the ground as your eyes and ears and your enforcement artillery is critical. We have a foundation on the ground that is essentially our artillery, but they're not there. They're there for more of the reputational checking, letting us know which families do what, which entrepreneurs are linked to whom, and who's unbiased or doesn't have a political position. And that's very vital information, and you can never develop that with a new team, even if you put them there for 5 years. I mean, our foundation in all of the countries that we have local presence are indigenous people that have been in the business community, been in the political community all of their lives. So their wealth of knowledge is Open Society Foundation's leverage wherever we go, and that's the thesis behind our investment, and that's the thesis of our foundation, is to enhance those that become our partners in those countries. But with this one particular investment, even though we knew the reputation of the entrepreneurs, the business community itself has its own operating system, and they were even blindsided by the way that the system works at some levels in Haiti. And so we unfortunately didn't do a thorough enough job of making sure that whatever they were signing up for with our capital, they understood the expectations behind it. And, it's all about how much skin do they have in the game. How much of their own cash are they putting into the investment? How much time are they committing to this? And then how do you manage that and control it without micromanaging, right? We're investors, we're not parents. So it's a fine balance, and it's a relationship. So you want to trust that those companies that you decide to invest in, but you want to make sure that they have enough leeway to operate and do their business. And board seats are important, but CFOs are critical. Someone that manages the books, middle-level management, who's actually doing the day-to-day operations, not just coming up with the strategy of the business. And that's where you can exert your leverage as an investor and pounce the minute you think that there's something going wrong, as opposed to waiting for that quarterly or annual board meeting to get an update. And that's the critical point. So you have to do it before you get in.
Can I just add one thing? I think that investors have very little leverage, basically, is the answer. Yeah. Very, very little leverage. And we actually had the deed on somebody's house. Mm-hmm. And we could have exercised that deed and taken their house. Mm-hmm. And then it's a call, do you do that? And then you say, well, what, this is not what we're in the business of doing.
It's the threat. It's the
So I think what we've come up with to try to get around that issue is if you look at the microfinance model, why did microfinance work? Well, it worked because there's no leverage when you deal with people individually, but when you deal with them in a collective, you get more leverage because there's peer pressure, right? So one of the things that we're trying to do, and I'm not saying that we really have the answers yet, but to the extent that you create a community of peers who have shared values, who have trust, who know each other, and who believe that we're all in this together to some degree, you then create a certain norm and a standard of behavior, which I think reinforces good behavior and basically kind of sets a tone of this is what we're trying to do. And it may not be legally enforceable, but I think building that culture around the importance of doing what you say and that kind of stuff, I think is really important. I mean, culture building is really absolutely critical to building a functioning ecosystem for early stage investing, in my opinion.
No, and I think that whether it's early stage investing and looking at the missing middle, I mean, even for some of the bigger projects I've seen, where they have miscalculated is, on what leverage they have. Investors have very little leverage, but what are they going to do? So let's just say you acquire a Kazakhstan bank as a bond investor. What do you do with that? I mean, you're not in a position sitting in New York as a portfolio manager to manage a Kazakhstan bank. So it's a tricky problem all around. I wanted to ask one final question and then open it up to the audience. But, Will, you mentioned that the number one issue is really creating jobs for graduates. And so I'd like each of you to just, when you look at the whole issue of what works to address extreme poverty, I mean, what do you feel actually has been most effective, most sustainable, and ingrained in the local community? And, I often will hear a variety of things. It's education, it's investing in women, it's, creating jobs. But when you look at this whole issue of, of really addressing poverty alleviation, what has been most effective in your operations? Go down the row and maybe start on the other end and work this way. Amie.
This is my personal opinion. This isn't necessarily SEDF's view, but my personal opinion is a full-time, consistent job for an individual that provides them a steady salary and benefits, if possible, by the SME. Maybe not the first day that the SME hires the employee, but eventually as that SME grows, they grow with the company. But some sort of ownership. I don't think day laboring or part-time jobs solve any problems. It has to be a permanent job in the community. And that coupled with obvious other basics, healthcare, water, education. But those don't stick unless the person has a job.
Gustavo?
I think I will start from the other side, and this is something that we saw when we were doing the Africa Health Fund. So that is basically a fund that is targeted only to do, or was targeted to do only healthcare in Africa for the BOP. Then we start realizing, wait a minute, some of these very big healthcare issues in Africa is because of a complete lack of education, HIV, right? So now it's an education healthcare issue. But wait a minute, some of these very bad healthcare issues are because of lack of nutrition. So that's food. So now it's a food, healthcare, education issue. And wait a minute, some of these things are because nobody has insurance here and nobody can go to the hospital. So now it becomes a little bit of a financial thing. So how to resolve the issue? I think it's basically focusing on the very basic needs. And and the problem is that I'm sure I'm saying something that is obvious and very general. So how you address it a little bit more on a targeted way? Well, we try with this healthcare fund, and there's microfinance funds, and there's education funds. In India, there's a ton of education funds, and I think I don't know. It's probably a compilation of everything.
So, Will, and so you had mentioned that the key thing is job creation, but how can you set it up so that you actually do create jobs that are self-sustaining, that's not part-time work or temporary, and that you can keep the model going?
Mm-hmm. Well, ultimately,
and get a 21% compound return.
Yeah. Well, it's not realized; it's on paper. We need to sell more product. Like, we need to compete with the likes of Lego, and we need to do well in your favorite New York toy store. We need to be in FAO Schwartz. We need to be sold in Pottery Barn Kids. We need to be at the MoMA store. And every sale that occurs, every container that's shipped, every pallet that goes out the door is ultimately securing the job. And I think that I won't go into this in detail. I think that we address needs at that level in the economy. I think certainly there are individuals, impoverished individuals within our country and others, which need food and water and medication and health care. And they're actually probably not even fit to work, but they need solutions as well. And so I think from our perspective, this is where the SME, the missing middle, should be focused, which is how do we connect? We talk about something internally called a relevant good. How do we produce a good in Honduras that somebody cares about in Russia? How do we produce a good in Honduras that somebody cares about in Japan? We do it through innovation and design. And ultimately, the only way that's possible for us is by actually being attached to the consumer, and that's our business model. But a lot of internal SMEs which focus on domestic products and services, that's less of their concern. But ultimately, I think what it comes down to is when you think about the top line driver, how do you actually drive revenue? How do you drive growth in revenue? How do you protect the revenue? How do you get repeat customers? You only do it if you're producing something better than your competitors at a good and affordable price. And when you can achieve that and consistently do that, what you eventually do is you require that somebody therefore delivers the product or service because customers shown up and they said they want it. And if you have to deliver the product or service, you need to employ people. So ultimately, it's not a very elegant answer, but we need to sell more product. And as we sell more product, we secure the future of our employees.
So, and Ben, on the whole issue of poverty alleviation, like, what has worked best? And maybe you could also describe to this group a little bit the Agoura Accelerator program and how that works as far as trying to actually jumpstart something and sort of get it to the next level more quickly.
Sure. I mean, I think the way you fight poverty is to create jobs, and the way you create jobs is by increasing productivity. And the way you increase productivity is often by innovating and identifying the best entrepreneurs and helping them to unleash their potential to grow businesses and create impact. And I think that our whole theory of change and our strong conviction is that the kind of key driver of wealth creation is an entrepreneur with certain characteristics. So this is an entrepreneur who is creating a company that will create massive jobs, good jobs. Will's company is only creating jobs, but it's actually improving the efficiency of the manufacturing sector in Honduras. And if you can do that, that has huge, huge spillover effects for the whole country. So jobs is huge, but also companies that are creating products and services that people actually want and need. And I would also add companies that are operating with a shared value mindset. So entrepreneurs who are deliberately trying to do more than just make money for themselves, but who have a real vision of how their company can contribute to their community. And that, I think, is almost a new way of thinking about business, and you're seeing a lot of new companies, particularly kind of the younger generation, like this is the kind of company they want to start. And so I do think that you're seeing this kind of paradigm shift in the U.S., and there's no reason why we can't accelerate it in the developing world, where you don't have necessarily the cultural support for that kind of view of business. So what we do with the accelerator is basically, and I don't know how many of you know what an accelerator is. I honestly didn't know what one was like a year and a half ago. But basically what an accelerator does is it identifies very high potential entrepreneurs with certain characteristics. So it could be tech entrepreneurs, or in our case, what we call impact entrepreneurs. So entrepreneurs who are also deliberately trying to address a social or environmental problem. And so an accelerator will then identify a select group of those entrepreneurs and then, in essence, deliver human, financial, and social capital to those entrepreneurs. Because all entrepreneurs, they need a support system. They need to actually understand themselves and become better leaders, because with early stage companies, you're focused, your number one issue is yourself, and are you prioritizing your time in the right way? And then also they obviously need access to investors. And so entrepreneurs come into our program, they go to a big retreat, then they actually in the future, because we've been changing, every year we sort of learn what works, what doesn't work, and we kind of tweak it. But next year, I think we will have about 30 companies from all across Latin America with revenue of under $1 million. Probably average revenue will be somewhere between $200,000 and $400,000. So these are not necessarily total, pre-revenue seed stage companies. They have some track record, they have some proof of concept, but they're right at that phase where they have tapped out their friends and family and they need external capital. And we know there's tons of impact investors who are looking to invest in these kind of companies, but they don't know how, they can't find them. And if they do find them, the companies are not necessarily embedded in kind of a support structure. And that is really what we do, is by embedding them in a whole support structure that does all kinds of things, from business model tweaking and innovation to then writing investment memorandums, telling them exactly what investors are going to look for. So, when you're looking at your entrepreneurs and you say, okay, well, I need, information on which to make a decision, and you look under the hood to see where's that information, you actually have it. Because I think one of the huge frustrations for investors is that they're spending way too much time trying to identify pipeline and then trying to do the deal. When I think all good early stage investors, what they want to be doing is adding value to the company. And I don't know how many of you know of Acumen Fund, but they're, probably most of you. Great organization. And I just found out that they've looked at 5,000 companies. 5,000 companies, and they've invested in 65. And on the one hand, you can say, wow, that's a very intense diligence process. On the other hand, you can say, that is a lot of time spent looking at business plans and not spent focusing on the companies. Right. And the way that we would look at that is to say, Well, that's great, but what happened to the other 4,935 companies that went through your pipeline? Are they getting any support? The ones you rejected, are they getting any, what's happened to them? Because we need to kind of be able, I think, to make it easier for good entrepreneurs to feel like there is a pathway to success. And right now, many entrepreneurs don't feel like that pathway exists.
Well, no, I mean, it's a fascinating conversation. We have 15 minutes left, and I'd love to open it up for questions from the floor for any of the panelists. Cover so much in so many different regions, and I've learned a tremendous amount as well, because I've sort of seen this evolution from how do you go from grants to loans that are repaid to something that's a self-sustaining model, and then how do you scale it? And I've also seen that a lot of the things that the panelists have talked about, it doesn't matter if you're doing a $100 million investment or a $250 million investment or $1 billion even. I mean, I've seen deals that have gone badly in some of these newer markets, and actually some very established markets as well, for all of the reasons that the panelists have mentioned. So let me open it up to please.
And this is to Gustavo. I mean, I face similar issue with capital raising. So how did you solve that? How did you pitch your investors and convince them that the social fund was a place to put money?
I think it's a little bit of what I said before. I think the only way to do this and get a shot is by having a very clear understanding of what the product is about. And the reason why I'm saying this, because institutional investors, and as much as I do, they will give you 5 times. They have 5 minutes to basically talk about what you need to talk. And if you're not clear, you're out. Now, it's also true that you need to find the right type of investors. I mean, you can't go and basically try to sell this kind of product to anyone, because you should know who's probably a buyer or not for this. But again, I think as much clear that we could be when we're trying to sell this product, the more helpful you will be in having a success with this. When we started with the Africa Health Fund, it was all over the place. It was returns going from 5%, and we said, no, we need to take it a little bit higher. Then when we did that, I was talking with foundations that were telling me, I'm happy to give you money, but we can get any return in exchange. I'm like, all right, great. Yeah, but no, it doesn't work that well. So you have to have a very clear, clean product to make your life a little bit easier.
Do you showcase the deal by transaction?
If I can do it now?
No, do you?
Yeah, of course. Yeah, of course.
So I see a couple hands over here on the side.
One thing that I struggle with is the difference between impact investing and responsible frontier market investing. Will, in your example, the 21% return, do you believe that's below the cost of capital of Honduras? Are you sacrificing, I guess, a profit by doing a more labor-intensive process that creates more jobs? I would imagine that labor-intensive makes sense in that environment, given the fact that there's probably poor electricity there. So can you just maybe speak to that?
That's a great question. I don't know about the cost of capital in Honduras, because we've never sourced capital from there. It's all been from outside the country. So we operate, in 2010 we did a 28% gross margin. In 2011 we did a 33% gross margin. We expect this year will probably be sort of mid-30s. The toy industry operates at sort of low to mid-40% margins. So if you think about that gap, if you will, we're steadily and actively attempting to address the gap. Our goal is not necessarily to be Mattel or Hasbro, but certainly we want to benchmark about what is possible in the marketplace. So if you were to sort of argue, and I don't think you could necessarily make this argument in our case, but I think certainly one might try to make it, you could say, well, look, you should have just outsourced it, produced it in Asia, they would have provided for you world-class manufacturing, and you would have essentially achieved industry margins right out of the gates. And if that argument were to hold true, then basically you could look at the gap and say that's the measure of Tegu's generosity towards Honduras. So we don't look at it that way. We want to be competitive. We're focused on a path which puts us to sort of world standards. But at the same time, one could argue that we have willfully accepted a lower gross margin on our product to benefit the nation of Honduras. We think we can grow out of that, but ultimately it could be the thing that kills us, right? So, long story short, that may be one way you could articulate the difference between saying yes to unestablished or underdeveloped region and no to a well-developed region. But that's potentially one way to sort of think about it.
So I see two questions. You've had your hand up for a while here in the front, and then we'll go back. That's it. Thank you.
Thank you. I work on privatization in Eastern Europe and then in Southeast Asia, and for me, the missing middle is essentially the kinds of companies that are between these big, either state-owned or privately owned monopolies, and then you have a lot of little businesses that are basically like family or a couple, you know. And for me, the idea of missing middle is really the companies that have the capability to grow and employ others. And so I thought that that's what you're going to address, is the idea of how do you identify companies that you avoid the oligopoly, both state and the big family people, because you cannot do business with them. They are out to rob you, essentially. So how do you identify the people among the little businesses that already exist that have a capacity to develop and to provide jobs to others? So that's one thing. But another thing I wanted to ask you is, did you consider like working with some of the, maybe foreign aid agencies? Because my experience has been that the legal systems of these countries are really designed to rob investors and to rob other people's money, really. And I've seen it, from Poland to Philippines, where I lived for a long time. It makes it very easy to deprive anybody who has money. And I've seen with the emigres, I've seen the members of their own families rob them just because the legal system really encourages it. And I think that if you do not change it in conjunction with some sort of aid agency, it will never work.
Yeah, I hear you about the governance problems. But to your question, which I think is a absolutely critical question of how do we find these companies? The answer is we do it in a number of ways. One, we have a network of kind of scouts, if you will, ambassadors, people who understand our process and what we're trying to do, who are all across the region that we've been cultivating over the last 7 years. And they provide great referrals. Our entrepreneurs themselves are some of our best referrers because it's in their self-interest that we build a community and build a brand. So we're getting amazing kind of inside referrals of all the best entrepreneurs in Honduras and Guatemala and Nicaragua through our existing entrepreneurs. And also, we're going to be engaging in a massive sort of social media campaign, basically. I mean, we're investing quite a lot in building our Spanish language website and branding what we do in such a way that it doesn't sound too development-y, right? It doesn't sound like, only people who are Mother Teresa and want to save the world need to apply, because that's not what we want. So what we're really trying to do is find great entrepreneurs who realize that there's no accelerator like us, and once they understand the value proposition, which is we're basically solving a lot of the key pain points of these entrepreneurs, all the stuff that they don't know how to do and don't want to learn how to do, because you got so many things to do as an entrepreneur. Do you really want to learn how to raise capital? I mean, in the US we have specialists that we bring in to help us do that. But in the developing world, often, those specialists don't exist or don't know what they're doing. So we try to serve that function, and we try to articulate to entrepreneurs that value proposition. So that's basically how we have it. But it's hard to do. It is, and to some degree, it's like squeezing water out of a stone. That's how I felt when we were just in Nicaragua, and it's one reason why we've expanded our footprint so that we can, find basically have a bigger pool of entrepreneurs from which to recruit.
I would just add one other way for sourcing deals in some of these countries is teaming up with business plan competitions, which is something that happens in a lot of the developing countries that we work in. And that at least gives the young and budding thinkers in that country a platform in which they can present their ideas. And then those competitions are usually coupled with some sort of support service that Ben was talking about, that's sort of an accelerator, or just business development services that allows these entrepreneurs to get the technical expertise that they might need so that they can then present themselves to an investor like us, or we'll invest with a local financial institution which will open up a line of credit for these entrepreneurs to then apply for as well. So there's lots of different models that sort of create channels for those that have never been talked to in these communities. Please.
Hi, this question is for Will. I suspect that many of the people in this room are trying to think about ways to deploy their time and energy along careers, along the social investing or social enterprise field. I'm just curious, you had a very distinct path of going and creating an organization for, in an area where you weren't particularly well suited to do. You just kind of showed up with you and your brother, and you pounded out an organization. It's a very different path, so I'm curious, would you encourage other people to consider it?
It's a long road. I think one of the unique things, what I didn't mention was my brother was in Honduras because he was working out of the Los Angeles practice of the Boston Consulting Group and was primarily focused on Latin American clients. We grew up in St. Louis, Missouri, but he has a real gift with languages. So he speaks, obviously, conversant Spanish, but business and engineering Spanish. And ultimately, and he moved there. So, I think one of the biggest challenges, and I've just been thinking about this in general, is, trying to attract basically leadership talent and management talent to these foreign opportunities. And our hope, actually, as a company, is to demonstrate a model of entrepreneurship that actually foments creativity amongst those that are watching. And we consider the product, for instance, in our case, an ambassador for the country of Honduras and its productive potential. I think that unless you're willing to undergo an incredible adventure, and by incredible and adventure I mean joy and tears and risk. We didn't talk about country risk earlier when the question came up about returns on capital, but we closed our first funding round, our sort of Series A, at the end of May 2009. And for those of you who might be familiar with what's going on in Central America, in June there was a coup in Honduras, and the president was ousted in the middle of the night. And so our investors sort of looked at us and said, okay, remember you said this country risk thing was sort of under wraps. And we're like, don't worry about it. But the reality is that you have to be a very particular individual, and I would also say that partnering with somebody locally who's as passionate as you are. Ben's partnered with a Nicaraguan native who is incredibly passionate and is on the ground in Nicaragua. And so I think that teaming up is one way to potentially do it. In terms of whether or not I would recommend it, it kind of just depends on the significance of your passion, ultimately. How much do you care about poverty? Is it just a nice alternative to a desk job here in New York City, or is it something you've sort of encountered firsthand and said, I see this, and there's a problem here, and I don't necessarily know the solution today, but I'm going to do something about it. And that's ultimately what my brother encountered when he decided that he wanted to do this. I mean, I was working downtown, and I got an email from him. He'd been traveling, he said, what if we started this company in Honduras? And I was like, oh, that's a good idea. Let me see how I can help you. No intention whatsoever of leaving a cushy job. But I think ultimately, if you're willing to sort of look out at the risks of personally losing financial security, the comforts of the developed world, and you're willing to sort of encounter discomfort for the benefit of others, ultimately, I think that then you may have a calling at some level. If you sort of look at yourself and say, I've got my limits, I can't go this far, then I wouldn't recommend it. Personally, it's a huge adjustment, and even when I travel down to Honduras, the rampant kidnappings and things of this nature, those make you uncomfortable. But to go and to live within that and to say willfully, I'm going to be a part of this, and I'm going to take on the risk of terrible driving and all these kind of health risks and everything else, and for the purpose of somebody else, I think ultimately you should search pretty deep within you before you make that decision.
Any other questions from anyone? Yes.
Thanks for talking to us today. I guess my question was in all the discussions about private equity and its limitations. Maybe one of you could talk to some of the best financial innovation you've seen, and what kind of products might work really well. Are we going to see more high yield style covenants or pick toggle type bond for a social enterprise? What can we expect to see, and what should we be thinking about ourselves?
That's great.
I think that's the question of the year for impact investing. I think, at least from what I've seen in the industry, people are concerned about what the return objectives are, how much economics there is to go around, even for a very dedicated team to put their lives behind this type of investing. And now funds are starting to think about how do you motivate, investors are starting to think about how do you motivate fund managers who want to do impact investing but tie them to social metrics as well as financial returns. So there's the financial innovation on that pillar, but then there's also financial innovation on how do you get more capital out to potential entrepreneurs, and there's a long discussion as to how do you get non-accredited investors into this asset class, and how do we get around the regulations and create investment opportunities. And Calvert has started to create indexes and things that as an individual investor can place capital, but I think there's a lot of thought that's going into that. And then there's the pillar of, here you have some investors at the table, how do we protect the capital that we do invest on behalf of others or even just one donor? And that goes to the structuring of the deals, and is it pure equity? Is it pure senior debt? What's in between that the more mature markets have been using all along, but the financial literacy of some of the entrepreneurs that we're placing capital with is not there. So how do we structure deals so that you're aligning incentives along the way as well as sharing the economics when you have to eventually pull your capital out? So there's lots of different discussions going on, but spend your career trying to help figure out those answers. I mean, I think it's still, the test is out right now.
We are, in our case, we're talking with retail platform, but to do credit rather than equity. And one of the reasons it was said here before is that most of the entrepreneurs in these emerging markets, in these small mid-market type of companies, prefer debt and not equity. And the other thing is that when we are talking to investors and you're talking about an equity return of 18, 20, 22% rather than a debt return of 12, 14%, most LPs or investors will feel more comfortable with a debt product that is supposedly much more secure, and it's giving you anywhere between 12 or 14% rather than 20 on the equity side. But then it's not much more complicated than that, or shouldn't be much more complicated than that, because then you end up destroying the whole system if you make it too complicated. It's more the source of capital, what Amie was talking about, retail. The type of asset class is equity, is debt, is infrastructure, is mess. It's a combination of everything. But not much more than that.
But I would add one last thing, and that's for equity investments, there needs to be a market for exits other than selling up to a traditional private equity. I mean, that is a natural exit for some of the deals that we work on, but that isn't the end-all be-all exit opportunity. So there have been some discussions of creating a securities exchange, but that it's still nascent, and it's happening out in the Far East where there's a larger deal pipeline of impact investment, loosely defined deals. But from a global perspective, I think there's still a lot of room for innovation.
I just add, I think crowdfunding is going to be huge in this space. Right now, the impact investing world is a very small world. It's a world of accredited investors and institutional funds and foundations, and none of those organizations are really well poised to invest in the early stage and the risky stuff. But the crowd has a huge tolerance for risk. And I think one interesting innovation we may see in the future is governments and multilateral institutions like, say, USAID could come in with certain kinds of guarantees that could guarantee, take first loss on a certain kind of loan, which could crowd in a lot of capital. AID has been doing this for a long time, but basically working with local banks that don't really want to lend anyhow, and that they don't pass on the savings to the entrepreneur. So it hasn't really been, in my mind, a particularly effective program, but I think it applied to the crowd, it could be incredibly effective.
Well, a lot of food for thought. I will leave time for the wine and cheese reception afterwards. So I'd like to thank Ben, Will, Gustavo, and Amie very much for being with us today, sharing their experiences and perspectives and giving us a lot of food for thought for how this asset class is developing. Thank you so much.